Everyone in the market is aware there's been a lot of capital raised and people have large fundraising plans in the market at the moment and coming down the track. It's no surprise that the market is attracting a lot of LP capital because the performance of the secondary industry, pretty much actually since inception, but certainly over the last decade, has been very strong. So it's attracting a lot of capital into the marketplace. What that means though is some of the larger groups in the market just raising bigger and bigger and bigger size funds, and we're seeing fund sizes of 8, 9, 10, 11 billion dollars, and in fact it was in the press the other day one group is raising $15 billion. When you combine that also with the debt that some of these larger guys in the marketplace are using on their transactions, that's a lot of capital in the marketplace that is focused on larger deals in the market. And what we're seeing in the marketplace is people that have raised that level of capital are under significant pressure to deploy capital into the market. And that's making the large end of the market very competitive. And it's important to understand, though, the secondary market is really broad now, is broad and diverse. Outside of that top end of the market, where we may see intense competition around these larger deals, there's a whole array of interesting, smaller, complex deals which will fall under the radar of the larger groups. And at Pantheon, we manage a disciplined amount of capital to ensure that we can go after these smaller deals where the deal isn't determined by the size of our fund, and the success of the deal is determined by the expertise of the team, our relationships, our understanding of the assets. And we have the ability to craft interesting transactions out of the spotlight, away from these large auction processes. So there has been a lot of capital raised. I think it's particularly impacting one part of the market, which is the larger end of the market. But there's a huge amount of deal flow outside of that. And if you have the ability to go after these smaller, more interesting transactions, there's some tremendous deal flow to be had. The market continues to mature. We see GPs changing the way they interact with secondary managers in two ways, actually. The first way was traditional LP deal flow, when you're just buying and selling a position in a private equity fund. What we've seen is GPs increasingly become selective about who they will work with, i.e. who they will allow to a transfer to occur to. And they want to work with people that could be potential long-term partners for their business. So people with a primary platform, people with fund-of-fund capabilities or primary capabilities that can invest in future fundraisers. The second point with regards to the GP-led market, GPs, I think, are now, certainly at the more creative end of the GP spectrum, are now starting to view secondary players as partners who can provide liquidity solutions wherever they may have an issue across either their LPs, across their fund, across a portion of their assets, or indeed around one individual asset. So they are now working with secondary players to construct creative new transactions which will allow them to take some liquidity off the table, manage the liquidity profile of their fund, manage the liquidity profile of an individual asset, but still maintain control of those positions. And so I think that part of the market will continue to increase over time as GPs become more creative. They work with secondary players and they realize that secondary players can provide liquidity solutions that benefit not only them, but their limited partners as well. I think as an extension of the point that I was just making, it won't be the biggest part of the market because currently it's a very small part of the market, but it's perhaps where I see the largest growth in the market coming, certainly proportionally, and that's around GP-led single asset transactions. So there's been a big growth in the GP-led market more broadly over the last 4 or 5 years, but that typically is at the fund level. Over the last year to 2 years, we have increasingly seen GPs look for liquidity solutions around either a subset of assets within their fund or indeed around an individual asset. And this may be a company within their portfolio mid-life through their ownership, where they want some liquidity to hand back some cash to their limited partners, manage the IRR, the liquidity profile of their fund, but still maintain control and still maintain some upside. Then they may work with a secondary player to buy a minority position. And that secondary player will then not be seeking to take control of the company. They will be working in partnership with the general partner who will remain a majority owner of the business. That kind of transaction I can see increasing rapidly. I think the potential for that market is huge Because if you think across the broad private equity market, most general partners that have several funds will have a company somewhere where they may want to take some cash off the table to de-risk. They may want to manage the liquidity profile of that company without giving up control. But the key for these transactions from a buyer's perspective is that you're aligned with the general partner. We do not want to be an escape route for a general partner for a poorly performing company. You must be aligned with the general partner and work in partnership with them rather than it being a buyer-seller relationship.